Richard Harris joins us now. Richard, good morning. Thank you for joining us. For a world which was shaking, things are looking better. Have markets by and large digested the impact of a trade war?
I don't think so because I think, the game's not over yet. We had Trump coming out with some rather strident comments. He kind of backed down pretty heavily when he actually spoke to the leaders themselves, and everybody says, well, it's just a negotiating ploy. But then we have to work out, what other negotiating ploys are out there. If he starts saber rattling and making policy from the stairs of Air Force One again, for instance, about Europe, then it could be really quite serious. Trade war between the US and Europe is very serious indeed. Now, I'm pretty sure that the Europeans, just as the Chinese, just as the Mexicans and Canadians, realize that if they throw Trump a few grains, he will back down on a lot of his more extreme pronouncements. But it still leaves a very difficult situation. People won't forget how aggressive he's been, even towards his allies, and they probably won't forgive either. So I think it's just made the whole tension between the US and many of its trading partners much more difficult. That's not going to go away.
But how does one deduce this entire piece? And would you say that the dollar is only going to become dearer? And would you say that the large chunk of the money flow is going to continue to be plowed back into US equities?
Well, I think in the short term, that's probably the case. I think where things are pretty important is if Trump's policies do start damaging the US economy, for instance, the kind of instability that we're seeing, may knock confidence. We're seeing the job numbers maybe not quite as strong as previously. The consumer is very important. If the consumer feels they're now getting a bad deal from Trump in the economy, then things may well turn around. So I think at the moment, yes, we have to look at a strong dollar. We have to look at the consumer still strong and companies still doing well. And don't forget, bull markets die hard. But I think looking further out, there is quite a danger now that Trump's policies will hurt the US economy. If that happens, then we may well see people starting to talk about recession and the Fed pulling interest rates down, and that'll pull the dollar down. So I think we're looking really at a game of two halves. Early in the year, I think we're going to see things carry on pretty much as they are. But then as confidence starts to weaken, then we may see a pullback in these indicators.
Do you think it's time now for, and our viewers who connect with India more, it is time to position for a dull second half for developed markets and a strong second half for emerging markets? Is it time to start positioning like that?
Well, I think it's always difficult to say that emerging markets will outperform global markets. If we see, for instance, 10% down in global markets, it's very difficult for emerging markets to buck that trend. It's just because emerging markets often react to, say, FII investment in India. It only takes a small allocation to go from Western markets into India to make a difference, and the same the other way around, because they're buying on the margin, and prices are actually made on the margin. So I think if world markets are difficult, then emerging markets will be the same. But I think if we carry on as we are now, then I think, emerging markets do look interesting. China looks very interesting now because it's in a recovery phase, I think, in 25. And also, I'm noticing there's a lot more interest in India from overseas asset allocators, partly because maybe they've discovered that India is an interesting market, that it may escape the kind of tariffs that we're seeing from China, and there'll be a lot of substitution with people maybe finding that India now is quite a good bet to manufacture in, as opposed to having all their eggs in one basket in China.
Okay, Richard, great to have you on the show. Thank you so much for your time this morning.
Thank you.